So you've got your stablecoins earning yield, maybe some ETH staked, but let's be honest, that APY, it can feel like it's all over the place, right?
Oh, absolutely. One minute it's great, next minute market swings and your earnings look, well, totally different. It's unpredictable.
Exactly. And you kind of wonder, is there a way to get a handle on that? Maybe even, I don't know, consistently boost your yield no matter if it's bull or bear season.
Well, that's precisely the problem Pendle is trying to tackle. It's this protocol designed to give users more control, more predictability over their DeFi yield.
More control. Okay, I like the sound of that. A listener actually pointed us towards Pendle, and the core idea seems to be this thing called yield tokenization. How does that actually work?
It's pretty neat, actually. Pendle takes a yield-bearing token. Let's use staked ETH, Steph, as an example. First, it wraps it into what they call an SY token, a standardized yield token. So Steph becomes SY Steph.
Okay, standardization.
Yeah.
Makes sense. What happens next?
This is the crucial part. They take that SY token and split it, right down the middle, essentially, into two new tokens, PT, the principal token, and YT, the yield token.
Whoa, okay, so PT is like the original staked ETH value, and YT is just the future yield.
Exactly. You've got it. The PT represents your underlying principal, and the YT is purely the right to claim the future yield generated by that principal. They've separated them.
Huh. That's interesting. So you've literally unbundled the asset from its earnings potential.
Precisely. That separation is the fundamental building block for everything else Pendle enables.
Okay, so now I have these two separate tokens, PT and YT. What do I do with them? I saw mention of a Pendle AMM.
Right, so these PT and YT tokens aren't just sitting there. You can actually trade them on Pendle's own automated market maker, their AMM.
An AMM just for these yield components.
Yeah. Now, the mechanics of the AMM itself are, quite complex under the hood. But for the average user wanting to trade PT or YT, you don't necessarily need a super deep dive into how the AMM works. Just know it's the engine making the trading possible.
Got it. Marketplace for principal and yield.
Yeah.
Makes sense. Now, quickly, the outline also mentioned Vipendle. Where does that fit in? Is it essential?
We can touch on it briefly. But Pendle is basically Pendle's governance token system. You lock Pendle tokens, get Vipendle, and that gives you voting power in the protocol and boosts your rewards if you're providing liquidity, for example.
Okay, so governance and rewards. Important for the ecosystem, but maybe not step one for understanding the yield strategies themselves.
Exactly. It's part of the incentive structure, but you can use the core PTYT functions without diving deep into Vipendle initially.
Right. So zooming out then, this isn't just some small DeFi experiment. I read Pendle has ambitions related to the traditional finance, the TradFi interest rate market.
Yeah, that's the bigger vision. The interest rate derivatives market in TradFi is, well, it's astronomical. We're talking over $400 trillion. Pendle aims to bring a piece of that, specifically the yield trading aspect, into DeFi.
Making that kind of financial tool more accessible on the blockchain.
Essentially, yes. Making sophisticated yield management available to anyone, not just big institutions. It could really increase capital efficiency in DeFi.
Okay, brings us back to the practical side. How does splitting yield and principal actually help me manage my earnings? What strategies does this unlock?
Good question. There are a few key ones. First, you can get a fixed yield. Imagine you have Steph but want a predictable return for, say, the next 6 months.
Instead of the floating rate.
Exactly. You can sell the YT, the variable yield component, and just hold the PT until its maturity date. That PT will eventually be redeemable for the underlying asset, so by buying PT at a discount today, you effectively lock in a fixed rate.
Ah, I see. You trade the uncertain future yield for a guaranteed rate now by buying the principal token at a discount. That's useful for stability.
Definitely. Then there's the opposite strategy, longing yield.
Betting on yield going up.
Precisely. If you think the yield on Steth, for instance, is going to increase more than the market currently expects, you can buy YT. You're essentially buying exposure just to yield component. If you're right and yields go up, the value of your YT could increase significantly.
So you can amplify your bet on yield direction without needing more of the underlying asset itself.
Exactly. And a third way is earning potentially more yield, maybe without adding huge extra risk.
How does that work?
By providing liquidity. You can deposit your Steth, for example, into the Pendle AM pool. You'll earn trading fees from people swapping PT Steth and YT Steth, plus potentially some Pendle rewards. It's another layer of yield on top of your base staking yield.
Okay, so liquidity provision adds another income stream from the trading activity. And you could probably combine these, right?
Yeah, absolutely. You could fix the yield on some assets, long the yield on others, provide liquidity. It allows for much more tailored yield management.
So wrapping this up, the core idea is that Pendle tokenizes yield. It splits yield-bearing assets into their principal, PT, and yield, YT components, lets you trade them on an AMM.
Which opens the door to strategies like locking in fixed yields, making targeted bets on future yield movements, or earning extra through liquidity providing.
It fundamentally changes how you can interact with yield in DeFi, moving beyond just holding and hoping.
That's the essence of it. Separating principal and yield gives you these new tools.
Okay, so a final thought for you listening. How might this ability to actually isolate, trade, and manage the yield part of your assets change your approach? Forget just APY chasing for a second. Could locking in rates, or specifically betting on yield increases, fit your goals? Which of these strategies fixed long liquidity feels like it might offer something new for your specific situation and risk tolerance? Definitely something to chew on as DeFi keeps evolving.